I'm Greg Schnell, the Canadian technician here to host the Market Buzz. This show looks at weekly setups across the U.S. market. Using the tools available on stock charts, we'll look for long time frame trades. Please subscribe to my articles and Twitter feeds. Okay, lots going on this week. I've been working hard trying to figure out where we're going here. 10 charts to ponder for the summer. We're going to work through some charts that I think are at important points, and we'll watch to see where those go. And I haven't included Japan or Germany in there, but I would like to. Anyway, I got other charts that are more important in the top 10. And then we're going to go through the consumer discretionary sector. There's 280 charts there. We're obviously not going to have time to go through 280 charts, but a quick way to decide what you want to get into and what you don't. Australia continues to make new highs, which is very bullish, and the US dollar continues to move higher, which I think puts pressure on foreign markets. So those are kind of the big issues that we're up against today. We're really only going to cover the top two, but I wanted to make note of these two things: Australia making new highs and the US dollar moving higher. So with those two, let's jump into the charts. What I want to start with here is copper, and let me just increase my screen a little bit for you there. There we go. Okay, so in this copper chart, the big thing that I think is important is copper has rolled over here. And the problem with this rollover, obviously, is when it's below zero, that's not very bullish, and it's rolled over just at zero. And this week, we're actually below zero on the momentum. And there's a giant uptrend off the 2002 low, and we came down and tested it in December, and here we sit. Well, we're still 10 cents above it, but I think copper was as low as 267 today. So with that, coming down a little bit further, and the real issue with copper being weak, obviously, is it's usually considered a good indicator of global demand. So watching that very closely to see how this ends up. So copper's my number one chart. My number two chart is, I'm going to go look at this lumber chart. And the point I want to make here is recently lumber tried to rally in the January rush and then has sold off, and now really holding this 300 level. And if I just snap a horizontal line on there, whoops, there, that's the line I'm looking for. Must not have saved it before. Save. So that horizontal line at 300, I think, is meaningful. And obviously, we've got this uptrend off the 09 lows that we'd like to see hold. But look at this ferocious rollover here. That's pretty bearish. And the last time we saw that was in 08. So there was another 2014-15, same idea. Anyway, you get the idea. Lumber down hard. So I'd be very cautious being in those stocks until we get a better showing. And the other thing you'll notice up here is the RSI is stuck under this 60 level. We saw that all the way through the 2013, 14, 15 period and the 07, 08, 09 period. So definitely bearish signals coming off the lumber market, and those were pretty good clues for us for broader weakness in the S&P. So that one's not great. Oh, I just want to go grab them because I got all these charts all set up for us today. And I want to go down to West Texas crude. Here we go. And looking at West Texas, we are on a bear market signal because we went below 30 on the RSI. We've bounced up and stalled at 60. That's typically not very bullish. And so we have this big giant downtrend line, and this line is a rough fit because it doesn't touch up here. It has two touches in here a little too high, and this touch is okay, and this touch is a little too high. So it's I'll call it a best fit line at this point. But more importantly, I think, is the horizontal level of $64, and I mentioned this before, but this is the support level for the bull market rally we had in 2018 in oil. And if we look to the left on the oil chart, this 64 level was pretty important back in 06, 07, before oil went on its final run. Now, I don't know if we're going to get any sort of final run here. I just know that $64 is an important kind of bullish level or bearish level, and we haven't we need to get back into that bullish mode, and so far we haven't. And the other day I looked at XOP and OIH, and those ETFs are just off so much. So considering that the oil market's still been trying to rally, those stocks just haven't been able to get going. I can show Brent briefly. I think the bigger issue on Brent, not that it's a one that I want to focus on. Let me just widen that chart out. 1250. The point on Brent here is that, you know, we've continued our rally, and let's say that there's an up channel either here or using this lower slope here. The bottom line is we still have this ceiling, this down slope in place. It's up around $90 on this chart. We're hovering above 70, and we're just barely above the 40-week moving average. So I would watch Brent really closely. I think if this rolls over, and again, rolling over just around zero is a problem for me, and I'd be cautious. We also got a bear market signal here, so now we draw a red line up here saying we don't expect the RSI to get much more above that. And we saw that all the way back in here for this whole big slide down in crude oil. So I'm still a little concerned about oil, and I think if oil rolls over hard, that will probably be a big indicator. So I've called it oil, but I've shown you two charts there, Brent and West Texas. So my number 4 chart is the Nasdaq 100. And the Nasdaq 100 is actually showing a different trait than the S&P. So the Nasdaq 100 actually was down at 30, but rallied all the way to 70, which is a very bullish trait. So that's important. So I've drawn a green line here because it's made it back to 70, and that restarts your bull market signals. We have this big important trend line coming in here, and now it's at about 6,400, 6,500. Obviously, we're up a lot higher than that. We're at 7,400. But in October, November, December, we came down and touched that line. Now, after trying to rally to new highs here, so far we failed. So we were at 7,700. Made it to 7,850, and now over here we're at 7,400. So the Nasdaq's in an important inflection point for me, failing to hold its double top. And again, getting down to this 30 is a very cautionary level because we haven't been down here since, you guessed it, 09. So that is the weakest relative strength on the Nasdaq in 10 years. So are we changing market behavior? One would think so, but this rally back up says it's still a bull market for the Nasdaq 100. Anyway, my problem here is we're at an awkward point. It looks to me like the PPO is going to roll over. It needs to hold this zero line, so it needs to kind of bounce and get going more like it did in 16, 17, and 18 in order for us to be able to keep rallying. So if this was a breakdown, the sudden thrust below suggests to me it's a final high and it rolls over for a while. And we saw that in 2015 where it went below zero, came up, final high, and rolled down. Back here in 2012, of course, we had all of the quantitative easing in here, so not much worked. But as soon as we got weak, that's when the government kicked in every time. So keep watching that. But in 07, we fell down, rallied up, and that next high was your final high, and then we rolled over. And the final high doesn't necessarily have to be the highest high, but it's just kind of saying the market got so weak, it's not holding up rallies anymore, so be careful on the next high. And it might be higher, it might be at the same height or lower. So that's concern level number 4. And then our next chart is the S&P 500. And just before I go there, so remember that this tagged 30 and rallied back up to 70. And when you get back up to 70, that's a bull market. I should make one more annotation here just to show everybody what I mean. So when we're in a strong bull market, the RSI holds this 40 level. Let's go get it. And, maybe even in this case, we have to go down to 35. But in general, still holding. This is the first time we got down this week since the 08-09 period. And that's what I think is an important statement. So let's not be... let's remember that fact, because I think it's pretty significant that, we've just seen more weakness than we've seen before. Okay, going down, I think I look at the S&P 500 a lot. Going down, looking at the S&P 500, in this particular case, the rally has taken us from 30 up to 60 and rolled over. And that's typically what we see in a bear market. So back here in 2007, we fell down. We only rallied up to 55 before falling over in 2011. And I'm always worried about this quantitative easing period, but we fell down and then we rallied straight back up and gave us another bull market signal and held up there for years until quantitative easing ended, made a new bear market low or a bear market signal, and then it took us, pretty much a year to get out of there before we finally broke out late 2016. So far this is signaling a bear market, and again, that signal that we got on the Nasdaq wasn't that comfortable. And we have a giant uptrend line, and I've used the July low in 2009 because that trend line has multiple touches, whereas the one off here and the one off here would just have two. But this is a pretty important trend line, and that comes in, let's call it 2650, 2700, somewhere in there. And so as we head through the summer, we want to make sure that those levels hold. The PPO is rolling over again, another dip below zero, and now a rally above, worried that this might be a final high. So, and again, it doesn't have to, but it's just a good precaution that normally you get a double dip down there. Okay, so that was chart number 5. The next chart I have is the IRX, and the IRX is alphabetically after H. The IRX has given us a signal here, and what we've got is the 40-week moving average. And back at 2000, the IRX, the 3-month Treasury yield, went below its 40-week moving average and stayed below it for kind of 3 years till all the way into the spring of 2004. Now, we don't care so much about the end. We want to care about the beginning. In 2007, it gave us a signal in early 2007, and the stock market topped, obviously, in October. But what we have here is the RSI showing us that when it goes below 50, that's a pretty important place to watch. And we're sitting at 50, and we're sitting right on the 40-week moving average. It's at 22.99995, so call it 23. And we're sitting down here at 23.20. So they're getting close. And the PPO, if it goes below zero, that's usually another sign after being above it for a long time that we need to pay attention to it. So that's another thing I'd be watching. The next question, or the next chart, chart number 7, is going to be the 5-year. And the big thing about the 5-year, and you could pick the 5-year or the 10-year. Again, I think everybody else is on the 10-year, so I'll just go with the 5-year just to give something different to check out. But look at how important this 2% level is on the 5-year. And we're down here around 2.17. So this is an important place on the chart, in my opinion, that after breaking out, we should rally up, find support, and take off to the upside. And if we don't get that bounce to the upside, I think that's even more important. And we've got a big uptrend here, and I've used, I'll call it, where you would have multiple support in 2018 rather than this low down here. It doesn't kind of match up with anything over here. So I've taken a best fit line through this 2016 period and come up here. So this point, I'll call it 1.75% interest rate. Obviously, if we look in here, this was a big ceiling back in the 2014-15. So pretty important place coming down here on the 5-year. We're clearly in a bear market signal here after staying up there for 5 years, rubbing down on the 30 level. So that's a problem. And we can see that the PPO is at one of the lowest levels it gets to down here, with the exception of the financial crisis. So I don't have an answer for how low it's going to go. I will just say it's already at an extreme. The real question is, does it continue to wobble lower? It doesn't have to escalate down, but it sure needs to start finding support somewhere in here. If it doesn't find support, I think that's going to tell us more about the wider trend. My chart number 8 is trucking, And one of the reasons I covered this off briefly last week, but whoops, DJUSTK. And I think this is just looking at that trend line. That goes back to the year 2000, and obviously we've had a couple of dips below it. The 2016 dip, the 09 dip was pretty major, and the 2000 dip was pretty major. So this uptrend is, I'll call it pretty prominent. And as long as it holds, that's pretty helpful. The issue I've got is we've rolled over at zero and gone below here. This is a pretty weak looking chart with that sort of price action. And you can see in 2015, we had that same thing where it rolled over below zero, and that rollover was a problem. Obviously, that made us take that 2016 spike low. We're rolling over right now, so I think there's still a lot of issues here, and the trucking companies will tell you that that they're seeing reduced freight volumes and that kind of thing. I think it's pretty important that this trend line holds at around 700. I wouldn't want to see that line snap too hard. Again, if it was going to go, you want that to be the final low by far. We do not want to see this big uptrend break. Okay, so my next one is the SOX index, the semiconductors, and we all know that it's been focused a little bit in the trade wars lately. The point I wanted to make on this chart, let's just go see one more time where I might have put it. Still S&P 500, OX, there it is. Don't know why I couldn't see it before. So the big point here is, here was our high back in 2000 for the semiconductors, and we wobbled up here. And again, I don't think this is support or resistance. It's just such a meaningful point on the chart that we spent a year here trying to get through it. And then we finally did. We had a sudden spike, and now we've given all of that back. And it looks to me like this is a considerable failed breakout. And the price action this week is taking us below that long-term level. And I've set this line at exactly 1362.10. More importantly, I think, is that we're rolling over on the PPO here after a trip below it. So this could mark a final high. And we'll just watch. The uptrend is still intact off the 09 lows, and that comes in around 1100. We're still well above that. But we have changed 250 points in the last 2 weeks, so we're about that same distance above the 1100. Anyway, pretty important chart and working towards that. So what is my number 10 chart? My number 10 chart is the Shanghai Index. And the reason I want to go through the Chinese market, not just because of the tariffs, in 2018, we had a big red trend line here, and this red trend line hit this low. It's kind of the out of these 3 or 4 lows here, it seemed to be close enough to this one. It's a best fit. Then it touched here multiple times in 2005, touched here in 2013 and 2014. And then we broke through it in 2018, rallied back up, and have now made a lower high than the previous high. So we've got a series of lower highs going on here. And we're testing that trend line again. So I think that one's pretty important. And again, we can zoom right in there just to see. This green line is the 40-week moving average. Obviously, we'd like that to hold. I do have one other level of support, and that is kind of this orange trend line that goes back, and it's a much more gradual slope, taking us from 1,000 to 3,000 over a 20-year period. And with that, I think, 2,500, I think this is still a line worth watching because of the long-term trend. And again, we did dip below this big red trend line, but let's watch and give it a little bit of space if it needs to get down below 2,500. I don't think I want to see it get much below 2,500. And with the PPO rolling over this aggressively, probably says to me that we got more problems. So watch the Shanghai closely. It doesn't look like a great chart to me. Okay, so that was kind of the 2 things that I think were big issues. I want to now go to the consumer discretionary. So I've called it retail up here, but it's really consumer discretionary. And the charts are set up quite interesting. I have ranked it by scooter ranking and then put the stocks in that order. But let's do a couple of things here. One is scroll down to the very bottom, and what we see here is, sorry, I should go down to the very bottom of the scooter rankings. Here's stamps.com, and if we look at these charts, we're going to see that, you know, these charts that have a very weak style to them, or dipping down hard, I think you'll agree the scooter does a good job of telling us it's pretty weak. And here's Francesco's, I think that's a restaurant chain. Kohl's plummeting, not looking very good. Here's Limited Brands, breaking down below support. So this list, the scooter ranking, just very quickly tells you what to avoid. And obviously we've got Macy's making new lows here, and that chart doesn't look investable. Here's Ascena Retail, Nordstrom's, Tailored. I mean, these names are just getting shot, and there's no real reason to step in front of them. Try and avoid them. So just using this quick list, you know, do you want to get involved in Weight Watchers? I don't think so. Do you want to get involved in Overstock? I don't think so. Wait until somebody else starts to build a base in these, and maybe in this case of Activision, if it doesn't break through $50, I don't think you want to own it. Here's Sears Holdings, and we're never surprised to see that in the bottom of the list. This Duluth is interesting because it was on such a rise last year, and now look at how bad that chart has fallen. So it does tell you to take profits when you get the chance. Michael Kors tried to rally. If anything, there's a double bottom here, but at least you can set your stop nice and close if you're wrong, but I'm not sure you need to do that. There's other names that are working better. So here's Gap Stores, Tapestry. Again, maybe trying to build a base here, but these names are pretty much out of favor. GameStop looks abysmal. JCPenney is now a penny stock. All of these things are ugly. Now we can go the other way. Fossil actually tried to bounce recently, and that was a failed break or failed bounce. TrueCar was a big name, and it's just like Duluth. It seems to have thrown in the towel. But let's go to the top of the list and work with what is working, and it's not necessarily in retail, but it is in consumer discretionary. So Match.com right now is obviously one of the better stocks up here, and you can see these names are really kind of firing. What's more interesting is when you scan through these, like these ones are so far extended that they're not really in a place you want to look for them. But Abercrombie, as an example, has pulled back. Now, if it was going to start to bounce here, it better bounce right now at this 25 level. And if it doesn't, you could probably move along. Here's Lululemon, been consolidating for the last 2 months around this 170 level. At least you've got something to shoot against. You'd put your stop just below that price action, and if it doesn't hold it, you're out. You know, there's other names like Costco, and I don't know if I already missed it, but you know, Costco, the chart looks a little bit better. Here's Ulta. Looks like it wants to head higher here. That's nice. Under Armour, there's been a lot of talk in the news, and you can see why. Trying to make a new 52-week high. Stocks like Flowers have kind of rolled over, even with the recent pullback. This Funko doesn't look very strong to me after the big spike high. Etsy's up in the right-hand corner. A little bit of a downtrend going on, so if it can't break above 70, I don't think you want to own it if you don't already. But looking through these, you know, just quickly highlighting them, so I've put them in a chart list and I've just sorted them by best stocks first. Here's Tractor Supply, and you can see consolidating for 2 months. If we wanted to go look at a bigger version of that. You know, this chart is up and to the right. It still looks pretty good. It's making a little bit lower highs in momentum, and there's an uptrend here on the lows that if this starts to break, I don't think you want to own it because of the lowering highs. But so far, it's still working. It's breaking above its $92 level. That was the previous highs back in 15, 16, and continues to try and work higher. The scooter ranking suggests it's holding up okay. I would just say it's starting to show some wobble below this 0 level after being up, or 75 level, after being up here for 6 months. So it just says that it's not as strong as it was, and you want to be careful if you start to see it break down. Now, looking at some of these other names, the shoe business seems to be all over this list. Here's Deckers, an automotive. This one's nice. Chemed just breaking out above 330. So nice looking chart. Laureate Education, same thing. But I think with the overall charts I started the show with today, you just want to make sure that if things don't hold up, you let them go. Don't let them become a big loss. Under Armour here, this is the other ticker, trying to get back above that 22 level. TAL Education Group, I think this is a Chinese company, and obviously they've been selling off. So that one's probably one to be avoided. Here's JD. Here's Costco. Now that stock's breaking out to new highs. You've got support at 245. If that doesn't hold, let somebody else own it. But at least the chart looks good. So Murphy USA, same thing here. But we're in this zone around the 70-75 level that I'd like to look in there to find stocks that are starting to break out instead of looking at the stuff that's already at 99. And as we come into the summer here, we should start to see some changes. So Shutterfly has been building this base for 6 months and looks like it wants to start taking out the prior highs. Maybe they've changed their business model. I don't know anything about it. All I know is that chart's starting to improve. After being in a big downtrend, it's consolidated sideways and looks like the base is being built. So Walmart Mexico, here's BIPS. This chart's rolling over. I would avoid it. It's breaking its uptrend. Amazon, trying to hold in here. I'm not that happy with the price action in all of the FANG names. Just when you group them together and go highlight over the list, they're not doing that well. So that is a bigger problem for me, and I think we really want to watch and make sure that if they're not going to hold up as a group, that's probably our biggest tell on what's going on. Groupon, again, trying to build a base here. I'm not sure that I'm a buyer, but just gives you some idea to go through and look for stocks, not necessarily at the top of the list, but maybe in the sweet spot of the list. So here's Columbia Sportswear bouncing off that 95 level. If it can't hold it, let somebody else own it. But it looks, from a bigger picture perspective, a nicer place on the chart. And again, you're up here, you had a big breakout, and then you've pulled back, and now you're right at support. So this is a place where at least you could look at it. If it doesn't hold the 40-week moving average, you're going to let somebody else own it. And if it does hold it, then at least you've got a nice place to pick it up as it tries to go higher. So all of these stocks, again, I don't think go to the top of the list. It's a nice place to look if you own them. But I think what you'd rather do is be somewhere down in the middle of the list. Okay, so hopefully that gives you some ideas. Lastly, let me just grab one more thing. I just want to show the US dollar making new highs. Let's just use UUP. And, this continues to push up here. If this is going to break out, that's a big deal. So watch that closely. Thanks for taking the time to join me on Market Buzz. Market Buzz airs on Wednesdays and Fridays at 10:30 a.m. Eastern, 7:30 a.m. Pacific on StockChartsTV. You can also catch replays on the StockCharts YouTube channel or on StockChartsTV, which has a running list of technical charting informational shows. Thank you.
Market direction is the single most important thing all investors need to know. Get the advice you need by joining dozens of elite money managers and financial experts, including Steve Forbes, Paul Merriman, Tom McClellan, and Keith Fitzgerald at the Money Show Seattle June 15th and 16th. You'll hear real-time market analysis and learn which stocks, bonds, funds, and commodities you should buy and sell to build a safer, more profitable portfolio. Claim your free pass at seattlemoneyshow.com.